This is TreppWire Week in Review for week ending December 24th. I'm Martha Kocher with Trepp, a data modeling and analytics firm for the CMBS, commercial real estate, and CLO markets. I'm with Manus Clancy, Senior Managing Director, and Joe McBride, Head of CRE Finance. And joining us this week is Lonnie Hendry, Head of Advisory Services. This week, the Omicron variant now accounts for most COVID cases, and the White House unveiled a plan to step up testing and vaccinations. And Biden's Build Back Better plan didn't pass go. A ton of economic data will be released in the next 24 hours before the shortened trading week. So far, the data is upbeat. Consumer confidence rose more than expected. Q3 GDP final numbers were revised upward, and existing home sales rose again last month. Joe, the concern over the speed of this variant spread has really stoked the fears, but it seems there's a little bit more of a we'll get through a sentiment, and it's showing in the market's rally, or is it simply the traditional Santa rally?
Yeah, so I think the theme for me, at least the last couple of days, has been, I guess, more positive than I would have normally expected out of kind of just the media and just the general landscape, especially given the fact that everybody and their mother now has the Omicron variant. And we are powering through nonetheless. I think, last week Manus spoke about worrying about, the NFL shutting down and the NBA shutting down and everything else. And you know what? As silly as it sounds, I do think that these large institutions, people look to these large institutions to see how to act, right? And some of them are JP Morgan and some of them are, Roger Goodell in the NFL or Adam Silver in the NBA. And I think yesterday I saw Adam Silver, the NBA commissioner, come out and basically say, listen, we're not suspending play. Like this is a new world where we're going to have to learn how to live with COVID and learn how to continue on with our lives despite this, this pandemic. And I find that to be relatively encouraging, right? Because I think that the narrative for a year and a half has been uptick in COVID, shut it down, right? Go get vaccinated, go get this, go get that. Now it's like, you know what? This thing is not as bad as the past waves in terms of hospitalizations and deaths and everything else. More and more people are getting it. So I think more and more people are realizing that, they're just going to have to get through it. And, the market seems to, they kind of puked a little bit when Manchin shut down the Build Back Better. But otherwise, if this was the Delta variant with the numbers that we're seeing with Omicron and there were hospitalizations and deaths following like they did with Delta, I think the markets would be doing a lot worse. So, generally I'm positive despite being in the COVID ward over here.
I think you make some good points, Joe, with Adam Silver in the NBA. I read today 97% of their players are fully vaccinated, to include at least one Johnson & Johnson or two of the other shots, and some even with the booster. I think for them, you can't tout that you have 97% vaccination rates and then make some, wholesale cancellation, postponement of the schedule. They have to just learn to live with it and push forward. So I think it's good. And I agree with you that the country at large focuses on those large institutions kind of as a proxy. So it's good to see them learning to live with it. And hopefully the numbers continue to show limited hospitalizations and we can just get along with our lives.
Yeah, I think we've seen on the corporate side, we talked last week about a lot of the corporations, I think, using the Christmas holiday break as a way to kind of buffer this thing. So they said we were going to be fully work from home for 2 weeks originally. Now we're just making it 4 weeks. So kind of under the guise of holiday times, some of the corporations are being a little bit conservative. But, I think in the NFL, if you get COVID and you're vaccinated, once you recover, you don't have to get tested for another 90 days. So I think that type of logic is great. And I hope that it continues kind of in the broader world, in the broader economy, because I don't think the market or people's psyches in general can handle another, 3 months of being stuck. So I'll leave it at that.
Well, you saw that the Delta CEO asked the CDC to shrink the quarantine time so that they could maintain a level of service that he felt he was concerned wouldn't be sustainable if they had to go to a full quarantine of 10 days. And Amazon announced today they're going back to masks, but the workers are still going to work.
I mean, this could be the best of all worlds when you think about it. On the one hand, as Lonnie said, really low hospitalization rates. Thus far, very few fatalities, which is a wonderful thing to hear. But we do have an extraordinary number of people that have gotten it already in the Northeast. In fact, I'm in a place right now where 3 of the 4 people in our apartment have it. Honestly, the symptoms are manageable, right? And that's what you hope for when you have something like this. But this is not about me. This is more about, the brighter side of the future, which is at the end of the day, if tens of millions of people get this with minimum symptoms and create natural immunity from it, that would be a wonderful thing. And that may usher in the end of the worst part of COVID-19, right? Instead of having 61% of our society being vaccinated, which I think is the latest CDC number, if we have 61% of the population with natural immunity on top of the vaccine, that's probably even better. And that may be the beginning of the end of COVID. We can only hope, right?
Turning to office, Trepp released a report done by our own Lonnie, who's here with us today, suggesting that there are some key parallels between the office sector and the retail sector. So Lonnie, it's a good report. I encourage people to download and read it, but give us some of the highlights and what's behind some of the numbers.
Yeah, thanks, Martha. So, it's really interesting. We've seen the demise of the Class B and C shopping mall play out before us over the last 2 years, even though it's been discussed for the last, couple of decades. And I think we're starting to see some cracks in the office sector. And I wanted to do a little bit of research to see if there were any parallels between what we've learned from the retail demise as well as potentially upcoming office demise. And I will say the office sector holistically is in a much better place than the regional mall space. There's a lot less delinquency. They're performing well today, but there are some parallels. If you look at the way these loans are financed, we track currently about 53 billion worth of regional and super regional malls in our data set. About 67% of those are full-term interest-only loans. If you look at the office sector, it's a lot larger. We have about 185 billion worth of office loans in our data, but about 131 billion are interest-only, so about 70%. So actually a higher concentration of office properties in our data set are full-term interest-only loans. What does that mean? Well, it means that if the market starts to slow down, the borrowers haven't paid any principal down on the loan, and they've been living off of this, appreciation over the term, able to cash out equity, refinance the property, and live to see another 10 years. Some of that stuff may not come to fruition during this downturn. So takeaways, foot traffic in malls can be a pretty good indicator that the mall's not going to make it. We parlay that into employee traffic in offices. So with the Castle systems reporting of how many employees are actually back in the office, hovering around 30 to 40% over the last month or so, you can see a pretty dramatic correlation between number of employees in the office and potential for lease rollover, downsizing, potential tenant defaults. Even if the tenants in the offices continue to pay their rent, there's definite downstream implications to the surrounding CRE marketplace due to a lack of employees being in the office. What we mean by that is restaurants and other service businesses that have for a long time survived based off of having those office tenants in the building and patronizing their shops for lunch and other things are going to suffer if this is prolonged. And then rent growth, if you look at that as a proxy, the office sector saw about a 13% rent growth from 2019 to 2020. But if you look at 2020 to 2021, that number was less than 2%. So you've already seen a pretty dramatic decrease in rental rates. So in the piece, we highlight this in a lot more detail, but I think the major takeaway is just that if you look back over the regional mall financing and you notice that most of those loans are interest-only full-term notes, and you draw a similar parallel to the office market being financed in the exact same way, and then some of these external forces potentially impacting offices negatively, you might be seeing something over the next 5 years, and we detailed upcoming maturity numbers. If those properties haven't seen any value appreciation, they may have a hard time refinancing it at the same levels that they were before.
Yeah, I would add to that, and it was a great piece, Lonnie. Thank you for putting that out. One thing that I would add is that I think we'll see a big similarity, maybe not in size of loss or downturn or so forth, but we will see similarities between, Class A malls did much, much better than Class B and Class C. And I think what we'll see in the office space is higher end, new product, Class A, ESG proved, with the kind of footprints that can attract Facebook or an Amazon or a Google and so forth. Those will parallel, at least in direction, the Class A malls. And that older stock, I think, will be more akin to the weaker performers that we saw in the B and C malls. Again, I think it's all relative. I think, if we see something in terms of value loss in the B and C offices that we saw in the malls, then our economy has a real problem at that point. But I do agree with the thesis that, to your point, the lack of amortization combined with lack of value appreciation and perhaps higher rates and higher cap rates down the road could end up creating problems for that part of the market.
Yeah, I agree. I think the B and C office is the one that's going to be disrupted here, if any. I would just say I didn't add, but in the piece we talk about, there's about 7.6 billion worth of single tenant office loan maturities coming up. And I think those present an interesting challenge, because in that instance, all of the negotiation power and leverage is on the side of the tenant at this point. If they are the sole tenant in your office property and they want a 20% reduction in rental rate, and you don't have a lot of options to backfill that space, as the property owner, you're going to be faced with some tough decisions. So I think that's something just anecdotally that also bears watching as we transition over the next few years.
I think that's a good segue. We had a couple of, I don't know, A's and B's in Manhattan this week. I think one of them was an old story that for whatever reason came back into the news cycle. It was maybe just because the deal closed. Boston Properties finalized its purchase of the leasehold interest in 360 Park Avenue South. We had actually talked about that several months ago. It was a rare 15-year CMBS office loan from a 2007 deal. And it's a single tenant office building with the tenant, I think, has already vacated or will be vacating this month. The price there was about a little under $700 a square foot, I believe. It was actually about $640 a square foot. Now, obviously, the fact that the tenant is vacating, you're probably getting a little bit of a depressed price. It was a $300 million total purchase price, which is actually slightly lower than the appraised value was in 2007 on this property. And I just throw that one out there, even though it's old news, because we also had the story of Hudson Commons, which is over on the west side, a relatively brand new, LEED certified, platinum, this and that, fancy dancy office building, right? That sold for $1 billion. And that's 700,000. That's about $1,400 a foot, which it just goes to show you exactly that divide that Madison, you were talking about, right? Is that these brand new, beautiful, tech enabled, J-Lo outside telling you about how clean the air is inside and all that other stuff. Like that it's a very clear dichotomy in the market.
J-Lo, Joe?
I know A-Rod, but I guess that's over. But yeah, the Blackstone one is interesting, or I should say the Hudson Commons one is interesting. There was a loan, I guess there still is a loan until the deal is finalized, in a Blackstone commercial real estate CLO. And I was looking at it and I saw the loan. It was like something like $60 million. Let me see if I could see it here. And I said, there's no way that can be the whole loan, because this is $1 billion property. And they actually had just sliced off basically like a $50 million or a $60 million piece of I think it was about a $655 million total loan, and put it in the CLO, which I just think that's pretty interesting. They're just slicing off pieces to create the exposure or the kind of offset that they like. But what is also, I guess, good and cool is the as is appraised value in 2019 of this property was $890 million. But the stabilized, or the kind of pro forma stabilized value, was $1.075 billion, expected to occur about halfway through 22. So they hit their $1 billion expected value 8 months early and are taking advantage of it. So good for them hitting those targets.
I have a couple of other office stories I'll run through and a must know. To the New York story, we saw last week that SL Green was selling off Hell's Kitchen office. It had only owned the property for a couple of years. They're selling 707 11th Avenue on Manhattan's west side for $95 million. That equates to $600 a square foot. That story comes from The Real Deal. Very modest profit for SL Green. They bought the property not even 2 years ago for $90 million. A couple of real nice green shoots. One in Charlotte. There's a new Honeywell headquarters in that city that just sold for $735 per square foot. That's the second highest total in terms of per square foot sales in that city, according to the Charlotte Business Journal. Price tag was $275 million. I think the only property that exceeded that 735 per square foot number was the recent sale of the Lowe's headquarters in Charlotte. A couple of Atlanta stories. There was an announcement that there was going to be started at the former AT&T building in Atlanta, a Center for Global Health Innovation. They will be taking 200,000 square feet at 675 Peachtree. That's near the Fox Theater down there, a great rock and roll venue. Really seen all of the greats over the years. Also in Atlanta, AT&T, in a fine segue, they renewed for 435,000 square feet, making it the second biggest lease in Atlanta in 2021 on Lenox Park Boulevard. That story comes from BizNow. And then our must know, I love this one, Spark Therapeutics is going to bring a 500,000 square foot innovation center to an area near Drexel University. It'll be at the intersection of 30th and Chestnut Streets. They will invest $600 million to create the center. And why is this a must know? It's a must know because anytime you see something like this coming into a neighborhood, it usually does something for the surrounding area in terms of lifting multifamily values, retail values, and so forth. So, and that's what I have on office.
Man, Spark Therapeutics, that one sounds, I think I may have lost $1 or $2 on that stock at one point or another back in the day. That might have been one of those Barron's CRISPR gene editing deals that didn't pan out, at least in the time when I owned the stock. Seems like it's panning out now. Manus, for fear of bringing us down a little bit, I do want to point out one more quick office story. I was actually a story in TreppWire this week, maybe even this morning. The $29.3 million one presidential loan, which makes up about 3% of a 2017 CMBS deal, was just put into special servicing. And I have to give you and the TreppWire team a shout out. You had written up a story 2 years ago, which had pointed out that the major tenant in this particular space, there was a story that they were taking up space, they were taking up a big block in another property. So they didn't say they were vacating this property, but that was the intuition that we found in that story. And there it is, right? And it's also worth mentioning because I have no idea how to pronounce where this is. One Presidential is backed by 133,000 square foot office in
Bala Kinwood. I lived there. I know how to say it.
Bala Kinwood,
That is
Pennsylvania.
correct.
Yep. Among many of the interesting places that our esteemed host Martha has lived.
Many.
You could have given me 100 guesses on that, and I wouldn't have come up with that pronunciation.
Yeah.
And even now, having heard it said 2 or 3 times by you and Joe, I can't even remember it.
It's definitely some Saxon spelling. Well, I had one story that I noticed that I'm surprised you guys didn't notice this. A lot of places canceled their office holiday parties. However, one marketing agency decided their holiday party was going to be in the metaverse. So you got to pick your avatar, and I guess in this virtual office land, talk to other people, have a conversation. You could get gift cards and other things that you could collect. I'm not sure how it works though.
So let me just ask this. I have two questions. What is the metaverse equivalent of being cornered by somebody from the company that you're not really so keen to speak to for 2.5 hours, but you have to? And when I used to play in the metaverse, meaning The Sims, I used to lock the people in the bathroom and just see what happened. Like what's the rules in the metaverse? Like, like when you go to the Christmas party in real life or the holiday party, you say, hey kid, don't drink too much. Don't say anything dumb to your boss or whatever. But like, what can you do? Can I go up and just like start bopping people on the head in the metaverse? Like what are the rules?
I think you probably for like $100 can buy like a metaverse wingman that you can substitute in when you've been cornered and you can exit stage
Want to
left.
avoid somebody.
Is the metaverse smart enough? Is there enough like intelligence in the process? I'm asking really Lonnie and Joe, because I know how you spend, 8 hours a day in the metaverse floating around, but can it sense that you're starting to slur your words and then can make your avatar start to kind of stumble a little and bob and weave? And is there that kind of intelligence in built into this thing?
Isn't that a storyline from one of your favorite movies, The Internship?
I do love The Internship. I don't know the part
They came up with an app which was like would prevent you from drunk dialing your ex-girlfriends.
That's a great app, but it's just, it would be great if that was also part of the AI
fun.
that was in there, which is in addition to sensing that you're starting to wobble a little bit, not only having your avatar kind of bob and weave, but throw in the random comment to your boss that, you spend the rest of the weekend thinking, am I going to get fired?
Well, I guess the last metaverse question is, can I kind of make myself look a lot better than I look in real life? Like, can I get the 6-pack? Can I get the huge biceps? Is that the jawline? Can I do that? Or is that against the rules also?
Will that be like undesirable at that
That's
point?
misrepresentation, Joe, honestly. And
Well, it is.
half the fun of the office party is the gossip the day after. So, where's the gossip at the metaverse? Don't know.
I don't know. It's on Reddit.
So moving on, according to a report, the number of homes for sale fell 18% in November to an all-time low. Supply chain issues and labor constraints have been some of the key challenges, but if there's a silver lining, it's been that it's kept the single family and the multi-family rental markets strong.
Yeah, I think this is something that we've kept an eye on, and I think we will into the future. This institutional capital outlay into this single family rental, non-traditional commercial investment space. I know Blackstone just made a deal to acquire Blue Rock Residential, about a $3.6 billion deal. They're going to buy the Blue Rock Residential Growth REIT. Blackstone acquires 30 multifamily rental buildings. They intend to spin off the single family rental segment of the business into a REIT called Blue Rock Homes Trust. And I can say in Texas and a lot of the other major markets in the South, a lot of these developers are starting to do build to rent type of construction. So they're building entire neighborhoods of subdivisions or subdivision neighborhoods, 200, 500 houses, where the builder developer just holds those into perpetuity and leases them out. And so it's really an interesting concept. I think we saw some of this coming out of 2007 when a lot of institutional capital came in and bought, foreclosed properties at rock bottom prices and tried to manage them like an apartment complex. But I think in this instance, we're seeing this at scale, and we're seeing this with a lot more precision, and we're seeing this executed by some of the major players in a more traditional CRE sense. And so they're treating this really as an institutional play. I think this will be something for us to keep an eye on into the future.
So Lonnie, I guess counterpoint, or I don't even know if it's a counterpoint, but I did see another kind of long Wall Street Journal article last week about how, hey, look, millennials are the biggest group of home buyers right now. They're buying 65% of the homes or some number like that. So it's like those progressive commercials, like we all become our parents. It might just happen a few years later. So what are you seeing in your area in terms of the residential market? I know that you're pretty heavily involved there.
Yeah, it's really interesting. So there's a lot of private equity money coming into the single family market. If you have a home priced at a moderate price point, in the South here, 500,000 or less, private equity firms are willing to make sight unseen, full price cash offers, close in 21 days and not just one or two. They'll buy an entire, submarket of properties, 2,500 houses over a 90-day period. It's challenging. That stat seems kind of aggressive to me because in my experience, the entry level starter home has been priced out for most first time buyers. And so for it to be 60+% would be very interesting to me. I've seen a lot of folks, that are wanting to buy be priced out. You can't save as fast as the rate of appreciation. And as Martha just mentioned, when you have a significant decline in listings of homes for sale, and you're competing with institutional buyers on the buy side, that supply and demand curve just continues to get out of whack for those first time, entry level type of purchasers.
I will say too, one more shout out for our boy Don Sheets. He sent out his sheets yesterday, and he went through the big thing that everyone talks about these days is inflation. And he went through the components of inflation, the biggest one being housing costs, right? Or what is it, owner's equivalent rent or something like that. And then he said, here's what it says in CPI, right? Which is like whatever, 5, 6, 7%, whatever the number is for that component. But then here's what we're seeing for average rent increases year over year, 10, 15, 20, 25%, depending on the market. Here's what we're seeing in Case-Shiller house price index increases, 10, 15, 20, 25%, right? So that's, I think the little kind of, I don't know, the message was that CPI is seemingly not capturing all these big giant increases that we're seeing in the underlying components. I also think that we may see it 6 months from now, because I do think that the rental portion of it takes a little bit longer to shake through the system, right? So I was reading something the other day that said, if house prices in general go up by 20%, rents follow 6 to 12 or 18 months later. So I think we'll continue to see kind of really, really strong rent growth on the multifamily side.
Turning to retail, big green shoot, super big. Spider-Man No Way Home shattered pandemic box office records. And I can tell you, I've seen it. I was at the theater. And in the theme of people are powering through in spite of the variant and its high transmissibility. So it's kind of an interesting story about people wanting to get back to the theater.
Nerds. No, I
was thinking about this the other day. We talk about from a product perspective, we're seeing the gamification of products and services. What if when COVID started, these movie production companies gamified the COVID and then the vaccine and everything else, and Spider-Man actually fell victim and he blazed a trail on how to heal himself with the vaccine or whatever. It might have spurred some people's opinions in a more positive light, because I do agree with you, Martha and Joe. It is kind of nerdy, but there's a lot of nerds that love this kind of stuff. And so it makes me wonder if we had gamified this instead of politicizing it, we might have seen some superior results relative.
I shouldn't say nerd. I just thought that was funny. I love the fact that people are going back to the movies. I'm a huge movie theater guy. Even before the pandemic, kind of once you have that kid or kids, you're out of the movies for 4 or 5 years. Thank God for Disney Plus. But I cannot wait to go back and get a large popcorn and a large, just syrupy soda and sit down for 2 hours and watch some mindless or some really artsy stuff. Either way, I'll take either one. But I guess, this is in that theme, Martha, you said it, right? This is in the theme of, well, people are actually willing to go out and be in a big room with other strangers. So this is good, right? It's kind of an indicator that people are potentially moving past this. Now, granted, this happened, I feel like this Omicron switch just really, really happened this past weekend. And now like everybody's all over it. The president came out and started talking more and more about it and so on. So maybe, who knows, we'll see what the box office receipts look like this weekend and next, but it's just positive, right? Good for Spider-Man. My 3-year-old son would be very, very happy about this.
Well, I'm like Joe and Martha. I'm a big movie guy and a big Spider-Man fan. I can't wait to get back in the game and go to a movie theater. I like that big wax cup with a lot of ice and a cherry Coke on top. Got some mall comps for us for this week. We don't see malls trade that often, but here we go. The shops at Beacon Lakes in Miami sold for $108 million. This equates to about $260 a square foot. The property is newly constructed and contains about 420,000 square feet. Like most of the stuff, it gets a premium price these days. It has a Home Depot as part of it, or something like that, not just Home Depot. But if you have a Home Depot, a Walmart, a Target, a Lowe's, that probably puts you in the top spot for getting financing, getting top dollar on your sale. Other tenants at that property: Ashley Furniture, Dick's, Ross Dress for Less, and Michael's JLL brokered that sale. Another mall comp here. This is the Western Mall in Sioux Falls, a 420,000 square foot property. This garnered $107 per square foot. This is kind of a totally different tenant base from the first story. This is a Best Buy and a movie theater as the top tenants, but no department stores. So kind of a mall adjacent type property. And then one last retail story, which I found interesting: the Lux Rodeo Drive hotel and retail component, which is a really high-end retail component. It includes a Rolex store and a Ferrari store, sold for $200 million. Why did this capture my attention? Well, we know that Rodeo Drive was targeted recently by some smash and grab robberies. You know, it didn't stop the buyer from shelling out $200 million for this particular asset, which I noted includes a hotel. The sellers were the Harcum family, and JLL again represented the seller.
So I think a nice segue here, Martha, from we went from Spider-Man into this is good for retail, right? A lot of movie theaters are in malls.
Dreamworks.
Into now we have this story this week, which actually I was actually surprised that it touches CMBS as well. Brookfield REIT is buying or is going to buy the Dreamworks campus in Glendale, California for $326.5 million from a joint venture between Hana Asset Management and Ocean West Capital Partners. I believe this was a Commercial Observer story. It's got to give them credit. And what I found very interesting, and kind of, it's one of those things you read and then you're like, oh, well, no, duh. You know, the epic, massive, I used a word today, which I don't know if it's the right word, maw, that needs to be fed. That maw is Netflix, Paramount, Hulu, Disney Plus, Peacock, HBO Max, blah, 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 blah. Like this whole streaming concept has just skyrocketed the demand for content. And so these spaces that you go to make this content has become a hotter and hotter part of the market. And that particular article went on to go even further and say that in the area around these spaces, around these studios or these sound lots or whatever the heck you call them, the rents in the office market and the occupancies in the office market in those areas are extremely high relative to kind of other average areas. So I thought that was a very interesting kind of concept. And it made me think too, I guess one more thing on the Dreamworks campus is that it actually backs a $62.75 million CMBS loan that was in a 2019 securitization. It's actually a large loan securitization, Manus. We don't see those that often anymore. The loan was slated to mature in 2022, and the complex was valued at $297 million in 2017 and just sold for $327. So that's really good. I was going to throw this curveball at you, Lonnie. Looking at a property like this, where it's not really industrial, it's not really retail, it's not, like, are there weird things that you have to take into account here when you're kind of trying to figure out what the value of these things is?
I don't have a lot of experience with those types of assets, but I would assume there's leases in place similar to what there would be in an office or a retail center. in this instance, it's just made for, production, movies, et cetera. So I would assume you'd look at the rent roll, you'd look at the leases, and see what that looks like relative to other things. I guess the challenge would be trying to find comparables from a rent perspective or from a cap rate perspective. It would be interesting. So maybe some of our listeners could chime in, send us some emails, and tell us how you might value a movie studio and what the market would say about that, because that's something I would definitely be interested in learning a little more about.
It also made me think to look up, because this is not a podcast unless Manus references Kohl's or I reference Yonkers. They had been building a $100 million Lionsgate movie and TV production studio in Yonkers right on the waterfront. And since I've been going into the office the last several months, it's actually been really, I've seen that part of Yonkers just grow and grow over the last several years, taking the train by it. And they are going to be cutting the ribbon on that Lionsgate production studio in January. So their first show that they're doing there is called Run the World, which I don't know that show, but I'm sure it's great. And when I read the positives in the Glendale story about the surrounding area, I just thought that was a great story for that particular area in Yonkers. They've been building it up, and that's good. But when you start getting films produced and you start having, all of a sudden another 500 or 1,000 people are showing up to that area every single day, that's just great for the surrounding office buildings, restaurants, retail centers, so on.
I used to be a Yonkers guy. I used to live in Yonkers, and sad to know that, I missed my moment in time. Maybe I could have been a character actor, had the timing been a little bit different, one of these quirky, sidekicks, maybe like a Kramer-like character.
You wouldn't really need to act that much,
True.
All right, turning to hotels, I know we have a couple of stories, Manus, that you wanted to cover.
Yeah, so very quickly, we'll run through those. We've talked about this for several weeks now, how the hotel market has been on fire. Next week, we're going to put out a piece which talks about, in TreppWire, another 8 to 10 large hotel loans that cured this month that went from 90 plus days delinquent to current. It's a real amazing, chain of events, twist of fate, I guess, for this particular market. Just how many of these things are reverting to being performing, and it's wonderful to see. On the comp side, I'll throw out a couple of things here. 2 hotels sold in Nashville this week. Courtyard by Marriott in Nashville. This is the one in the Arts District on 4th Avenue, $520,000 per key. The reason I give the address is that there's several Marriotts in Nashville. This is a 192 key hotel, sold for just under $100 million. More Nashville, the Holiday Inn and Suites Nashville sells for $325K per key. This is the one in the Sobro neighborhood, again on 4th Avenue, 415 4th Avenue, a 230 key hotel. In Savannah, Georgia, the Alida sells for $600,000 per key, sales price of $103 million. Miami Beach Surfside sold for $70 million, which amounts to $400,000 per key. That story comes from Brian Bandel of the South Florida Business Journal, the hardest working man in South Florida. That guy puts out more stories on the commercial real estate market in that area than anybody I know.
I miss Brian. We used to talk to him a lot back when I was just a lowly press relations 23-year-old, but he's got a couple of murder mystery novels as well.
Haley
So
just
you gotta go
pointed to
check that out.
herself.
No kidding. Murder mystery novels. Maybe we'll have to have him on the pod and change it up sometime. Maybe get him to mix it up between commercial real estate and the art world. I like.
Haley's not lowly though. I was lowly
Haley's the hardest working person in
show business.
Podcast world and show business right now, right? It used to be James Brown, and now it's Haley Keene. One or two more in Florida. Tampa Ramada. This was purchased by Cardinal Point Management. It bought the 237 key Ramada Tampa West Shore, $80K per room. That comes from the Tampa Bay Business Journal. And the West Palm Beach Hotel, known as the Homewood Suites by Hilton West Palm Beach, that sold for $135,000 per key. The buyer was through Wall Street Capital. So the theme here for hotels is that it's a real parade of good news right now. I hope it keeps going.
We just talked about specialized property types like production studios. Another one that's done very well during the pandemic is self-storage. And we saw a story about that in the Wall Street Journal. I know Lonnie is particularly interested in self-storage, perhaps because he's got a lot of stuff.
Well, I've been tracking the self-storage market for a while. I know at the beginning of the pandemic, we actually had several media requests pertaining to the self-storage industry because it was very resilient at the onset of the pandemic, because it's a fairly stable, generally speaking, low rent growth, high occupancy type of property sector. But, it's really persevered through COVID really well and has actually become kind of a favorite asset class for a lot of investors. So I went back and pulled some numbers. If you look at what we track in our data from December of 2016 to November of 21, we've seen about a 48% increase in total loan balance. So we were tracking around 1,600 properties in December of 16 to the tune of about 12.27 billion. That balance has grown to over 18.2 billion and about 1,900 loans right now. So, there's been a lot of Twitter talk around self-storage properties, kind of an alternative. We talked earlier about the single family rental market. I think self-storage has really benefited as well as yields have gotten compressed in some of the preferred asset classes. Self-storage has really kind of come into a lot of people's purview as a potential option. And so we've seen, a lot more activity, a lot more issuance. What's interesting in our data, if you look at the average loan balance from 16 to 21, in 2016, average loan balance was about 7.5 million. And currently in November 21, it was about 9.6 million, which I think was a little counterintuitive. I would have thought that the loan balance may have gone down because a lot of these secondary, tertiary markets have seen an influx of investment activity. But this would indicate that maybe some of the big players, and I think Wall Street Journal had an article today that said Public Storage and a few of the national, publicly traded folks were sitting at all-time high occupancies and other things. So it's probably a pretty good mix between the local, value add reposition type of opportunity, as well as the stable publicly traded assets.
I actually had a good friend who used to be a consultant in the self-storage industry. And I remember at the beginning, I actually was just reminded of it when you mentioned, Lonnie, because we did talk about it early on in the pandemic on the pod. And I had texted him and, he said, which I never really thought of. It's obvious after he told me, but one of the biggest drivers of self-storage demand is people moving, right? So I got to store a bunch of my stuff while I move for 3 or 4 months, or I'm downsizing. So then I'm going to put a lot of my stuff in storage and then just forget about it and leave it, keep paying the $100 a month or whatever it is. So we had tons of people moving during COVID, right? Getting out of the city, moving into houses, moving from, California to Texas, moving from New York to Florida or whatever it may be. So you had a lot of that. And then maybe more of my kind of macroeconomic brain thinking, when you basically double the money, when the Federal Reserve basically doubles the money supply, and a lot of the, I guess, upper middle and upper income folks continue to work, but aren't spending money on vacations and restaurants and other things, they just buy a bunch of crap, sit home, right, and order a bunch of stuff off Amazon. So we filled our houses, we filled our storage units, and now we have to buy NFTs and buy, our boss an inappropriate drink in the Metaverse office party. So it all comes full circle.
Shoutouts. Manis, do you remember when you talked about the whammy bar and the wah-wah pedal last week?
I sure do.
Well, Matt O was a little concerned that you may have confused those two things. And he actually sent us pictures and explanations of the difference between the two of them, and even gave us examples. So Eddie Van Halen, whom everybody knows, was well known for using the whammy bar. The whammy bar adds a vibrato to the guitar.
Ooh,
and Jimi Hendrix is known for the wah-wah pedal. And the wah-wah pedal, or wah pedal, has the onomatopoeic name for the sound that it makes, like wah-wah.
Oh, see? So I was wrong. The wah is the wah, 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 wah.
So there you go. So thank you, Matt.
The whammy is the wee, 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 right? Something like that.
That's it. Now you got it.
Got it.
Won't
Thanks,
do that
Oz.
again.
I should say that, hopefully our listeners will give us a pass for anything foolish and off the beaten path we say today. We're all heavily medicated.
Today or the last 2 years?
I was going to say, you mean all 18 months of this podcast? And a couple more shout outs. BB Dog Tenacity gave us a Twitter shout commenting on episode 113 on hotel cancellations, office, and CMBX 6. And then, Manis, I don't know about this shout out. Kids on a bar crawl were talking about the podcast. Who talk about nerds? Who are these kids?
Oh my goodness, I forgot about this one. So before I tested positive, 4 or 5 days before I tested positive, I was at a dinner party. And one of the women at the dinner party said, my daughter went on a bar crawl in Manhattan. It was called the 12 Pubs of Christmas. And she started talking to some guy who started talking about the Trepp podcast. And just for maybe pulling it together, this woman's daughter was in CMBS for a while. So maybe CMBS came up and maybe it wasn't incredibly random. So this shout out goes to Connor of the 12 Pubs of Christmas bar crawl. We know who you are. And I'm kind of disappointed I didn't get some emails from you at 2 a.m. comparing IPAs to LTVs.
So closing out, we've got not many more days to shop for Christmas, and it sounds like you guys might have to stay home. So I got a couple ideas for you. If you missed out on the NFT on the first text ever, it went for 121,000. It's simply read "Merry Christmas." Sorry, that was sold and auctioned off to a Parisian on Tuesday. However, you could probably get in on the Under Armour Steph Curry sneakers for only $333, actually. And these are the sneakers Curry wore, well, virtually, of course, when he broke the all-time NBA record for 3-point shots. That'd be kind of cool. You wear them in the metaverse at the
He
office
happened
party.
to break it in Madison Square Garden against the Knicks, which is just fitting, right? Jordan comes into MSG and scores 80 points. So does Kobe. So does LeBron. The dreaded Knicks. But I will say, if we're buying anybody NFT sneakers, it's going to be Manis buying those super white dad New Balance NFT sneakers, the super comfortable ones that you buy like 30 pairs of that will last you for the rest of your life.
That's me. I mean, I've reverted to wearing like the little boy shoes now. The Merrells that you get your kids when they were in grade school so that they wouldn't have to tie their
Solid shoes.
They just slide their feet in. I went full childhood footwear about 5 years ago. I got tired of bending over and tying my shoelaces. I got really tired of doing it in airports. And I went full black Merrells. Easy in, easy out.
And with that, we are out. Thanks to Lonnie for joining us today and adding some rigor to today's episode. Thank you to our producer, Haley Keene. Next week, we'll have our predictions and resolutions. If you have a question or comment, send an email to podcast@trepp.com and subscribe to the podcast with your favorite provider. Happy holidays, everybody. Thank you for listening and stay well.
All right.